my two colleagues over here. So again, I'm Joanna, co-founder of the Smart Investor. We have Chin Hui Leong, who is
Hello.
my fellow co-founder here at the Smart Investor. And joining us this evening is also Royston Young, our portfolio manager at the Smart. So between us, we've spent years building and managing the Smart Dividend Portfolio, which is our flagship Singapore portfolio service that invests in Singapore dividend stocks. So this is a real money portfolio that's already delivered us. This is real money, so over $15,600 in dividends. That's cash, and over 30% total return. So this evening, we'll be starting with the presentation. I will just, I have a couple of slides to share. Royston will continue, and then we will open the floor up for a live Q&A session. You can send in your questions anytime, even right now, using the Q&A button at the bottom of your screen. Send it in during my presentation, during Royston's presentation, while I'm talking right now. Remember, we will be focusing on Singapore dividend stocks. We will stop accepting questions in the last 15 minutes of this session. So send in your questions as early as you can to make sure that we can get to it. And what we'll do, I really like you to send in early, because what we can do is we can collate. We always have so many questions, right? So we'll try to collate them together, and then we'll answer them together. So, okay, so just so you know, tonight's session is being recorded, and we'll send out a recording tomorrow so that you can revisit all these insights and our discussion at your convenience. Okay, before I continue, I'm just going to quickly jump in to look at the chat and see what everybody wants, what's everybody talking. By the way, if you're sending questions, don't use the chat anymore if you can, okay? Use the Q&A button so that I can track, because I've seen a couple of questions inside the chat right now. Please move them over to the Q&A question if you can. Oh, somebody says invest 50%, wait 50%. Actually,
That's not a bad idea.
to choose one or the other, but I guess you could do that too. Okay. Yeah. Oh, 10,000 is too little. All right, put in more then. Okay, so it seems like majority of the audience here is saying invest tonight. Okay, so what we will do is I will start my presentation in just a bit. And maybe Royston, if you could share your screen right now, let's jump in to the presentation first, and then we can I can talk at the same time.
Okay, hold on. Okay, yes.
Okay, sorry. So I've already done my introduction, and we are going to and okay. So again, let's dive in. The STI is over 4,200 for 4,200. That's the way the Americans say it, right? 4,200 here in Singapore, more than just a headline. So I think the question on everybody's mind is, how can we position our portfolio? How can we take advantage of what's happening in the market today? Does it still have room to run? Okay, let's start with a quick look at the market. The STI is at records high, right? It's not just a milestone, really. It's also a signal that there is a lot of confidence in the Singapore market. There is a lot of momentum. And part of it, yes, is definitely from MAS's commitment to pump in $5 billion in the market. And also another reason is also because many blue chips are reporting higher earnings. They are paying bigger dividends. Now, here's the thing. Moments like this, sometimes it does make people hesitate. Is it too high? Some will jump in, others will hold back, or maybe some will do a 50-50 like we saw, right? But in our portfolio, maybe just to share with everyone this evening, the companies that we own are not just paying more and more dividends, they're growing in value too. So that's why having a very clear strategy really matters, because when there's opportunity, you want to be ready for it. Let's go to the next slide, how we approach moments like this. Now, when markets are at records high, it's very easy to feel FOMO. You are afraid that you miss out, right? And you just want to rush in. But here at the Smart Investor, we take a different approach. We would like to focus on businesses with very strong fundamentals, sustainable dividends, and our goal is to build a balanced portfolio that can weather any kind of market cycle. So it means that we're not guessing, we're not chasing momentum. We are making decisions that have allowed our portfolio to deliver both income and growth consistently over the years. It's a system that we've refined over several years, and it's the same one that our members, for those of you here with us tonight, follow alongside with us. So and let's next slide, please. So we do have proven results. This is our actual track record I wanted to share with you. From investing real money. This is real Singapore dollars. The same way I think some of our members invest with us. We've collected, like I said, over $15,600 in dividends. Our returns are over 30%, capital gains 19%. But when we invested, it wasn't in a perfect condition. We invested through COVID. We invested through interest rate hikes. We invested through all sorts of market conditions. So the idea is that you want something that can withstand the test of time. And that's the power of having a proven process, because it keeps working no matter what the headlines say. So next slide, please. And I think that brings us to the question on everybody's minds. Where can the market go from here? What's next for the STI? Can it keep going higher? What will happen when interest rates start to move? And which companies are in the best position then to deliver both income and growth? So to dig into these questions and to share 3 blue chip companies, using those blue chip companies as examples, I'm going to hand over to Royston, who's our portfolio manager. By the way he's going to go through the companies is sort of a very like a snapshot, or rather a sliver of how we look at the company. So we're just trying to show you how we would look at companies. So what to buy, why, and how it fits into a long-term dividend plan. So Royston, go ahead.
Yeah, hi everybody. Thanks for joining us this evening. So I'll be going through a presentation on whether the STI can indeed soar higher. Okay. So if you look at the recent headlines, the STI broke several records already year to date. Okay, so you can see this 4th July, just about a month ago, it broke the 4,000 mark. Okay. And then after that, on July 21st, you can see that the STI actually broke the 4,200 mark, like what Joanna said earlier. Okay. But there's something strange though about all these records. If you notice, the 3 local banks did not contribute to the bulk of the index's rise. In fact, the surge in the STI was more broad-based. Okay, broad-based meaning that other blue chip stocks contributed to the rise other than the 3 local banks. So what does this mean? I mean, is it a good or a bad thing? We feel that it is very positive to see other stocks contributing to the STI's rise, as this means that there's less reliance on the 3 banks to carry the index higher. Because why? Banks are notoriously sensitive to interest rates and also macroeconomic conditions. So should, let's say, a recession occur, the 3 banks obviously will be very badly affected. And of course, it will drag down the index. So let's have a quick analysis of the STI. So look, this is to look at the key components that make up the index as of 31st March 2025. DBS, of course, is the one that takes up the largest weight, is 25%. OCBC is about 16%, and UOB about 12.4%. So together, you might be surprised by this, the 3 banks actually take up more than half of the STI. That's the reason why, I mean, if the 3 of them move, then it definitely has a very big effect on the STI. However, there are other stocks that also take up quite a substantial portion of the index, although not as much as the 3 banks. So as you can see, Singtel, CapitaLand, Integrated Commercial Trust, and Keppel take up these percentages respectively. And then we have SGX Group and ST Engineering. And of course, we have CapitaLand, Ascendas REIT, and Zemcorp Industries. So you can see these are the other blue chip stocks that are just below the 3 banks in terms of weightage. So now I would just like to briefly talk about interest rates, because that's probably on everyone's mind as well. Okay, so if you take note, CICT, which is CapitaLand Integrated Commercial Trust, and CapitaLand Ascendas REIT, they both take up 3.1% and 2.6% weight in the STI respectively. So the current consensus is that interest rates look poised to stay higher for longer. And this is because of Trump's tariffs. I think by now, all of you would have read about his widespread tariffs that affect more than 140 countries. So because of these tariffs, they are actually set to raise prices of goods and services. And because inflation might occur as a result of these tariffs, interest rates are also likely to stay higher because the US central bank does not really want to reduce rates for fear of inflation rising up again. However, recent data from the labor market as well as inflation data points to a weakening economy. So this is where it gets a bit tricky. When the economy is weaker, then the central bank in the US would want to cut interest rates to stimulate economic growth. And yet, if inflation gets too high, they would want to keep interest rates high. So obviously, it's not an easy decision here. But right now, the current expectation out in the market is for a 90% probability of a rate cut when central bank officials meet sometime next month. Okay? And remember that if they do cut rates, this will be the first time this year that the US Federal Reserve will be cutting interest rates. So as we know, REITs are actually very sensitive to interest rates because they rely on borrowings to fund their operations, acquisitions, and AEIs, which stands for Asset Enhancement Initiatives, or what you call renovations for their assets. Hence, of course, lower rates will definitely benefit these two REITs. And if you look at CICT's recent results, it actually reported a small 3.5% year-on-year rise in its distribution per unit. For CapitaLand Ascendas REIT, well, its DPU did drop a little, but it's only a 0.6% dip, which is, I would say, very minor. So actually, both REITs look poised to do much better should interest rates get cut. Then you might be asking, how about the other non-bank, non-REIT STI stocks? So how are they doing? Well, let's look at SGX Group as the first example. SGX Group takes up 2.9% of the STI and is Singapore's only BOS operator, meaning that the company actually enjoys a natural monopoly because there's only one stock exchange operator in Singapore. So if you look at net revenue for the company, it was just reported recently. This is for the year ended 30th June 2025. It was actually up about 12% year on year, and it was a new record for the company. And adjusted net profit, meaning net profit excluding one-off items, it also hit a new record, up 16% year on year. And what happened? The group actually increased its final dividend from 9 cents to 10.5 cents. But there's more. SGX Group also announced a progressive increase in their dividends by 0.25 cents every single quarter for the next 3 fiscal years. Okay? So you're looking at 2026 to 2028. So as you can see from the picture, right now, SGX is paying out 37.5 cents for FY 2025. But if it actually manages to increase its dividend as it said it plans to, by 2028, you can see dividends hit 52.5 cents, which is 40% higher than what it is now. Of course, the caveat is that these dividend increases are subject to earnings growth. Should anything happen with earnings or earnings don't do well, then the management will not implement these dividend increases. But the fact that they have actually communicated this in black and white shows that they have confidence that they can meet this target. And because of this confidence, SGX's share price has actually done very well. It has actually risen 25% year to date. Next, we look at Keppel. I'm sure all of you know what Keppel is. It's one of the large blue chip companies on the STI, which takes up 2.6%. Keppel also reported a strong set of results for the first half. So for New Keppel, okay, a bit of explanation here. New Keppel represents Keppel that does not include their offshore and marine business. So what happens is Keppel spun off its offshore and marine business and it's now become more asset light. So if you're looking at just the New Keppel alone without the offshore and marine, its net profit actually surged 25% year on year for the first half. And it's also growing its funds under management from 85 billion to 91 billion. Next, recurring income also increased from 414 to 444 million over the same period. So as you can see, there's a lot of good things happening for Keppel. Okay, it's becoming asset light, it's growing its recurring income. Well, it did not increase its interim dividend. It was kept the same at 15 cents. However, the company did announce a 500 million share buyback program. Also, year to date, the company has actually um, engaged in $6.5 billion worth of acquisitions and divestments because it's pursuing an asset-light strategy. Keppel also has a Vision 2030 goal, which it came up with in 2020, is to actually build its funds under management to 200 billion in order to achieve $1 billion worth of asset management fees. Okay, this is actually, I would say, quite an ambitious goal because for the first half of 2025, the asset management fees were just 195 million. Or if you just double that, it's actually about 390 million for the whole of 2025. So it's still some way away from $1 billion. So the company aims to monetize $14.4 billion of non-core portfolio assets in order to fund growth and reward shareholders. And just earlier this week, you may have read the news. Keppel has announced that it will sell off M1, yes, that's the telco, to Simba Telecom for $1.43 billion. So, of course, because it made this sale and is going to receive $1 billion in cash, it definitely increases the chances of a special dividend from the company. And because of all this, its share price has increased by 21% year to date. Also did almost as well as SGX in terms of share price performance. Okay, now we move on to the third company, which is ST Engineering. This is probably another very familiar name to all of you. It takes up a 2.8% weight within the STI, and its earnings are going to be released tomorrow. So since we can't have the first half earnings, we actually took the first quarter of 2025 numbers, which is revenue grew 8% year on year and hit 2.9 billion. And the company also snagged contracts of about 4.4 billion with an order book of 29.8 billion. So remember those numbers. And it pays a quarterly dividend of 4 cents per share. So in 2Q 2025, or the second quarter, it secured contracts of 4.7 billion, which is slightly more than the 4.4 billion in first quarter. So if you think about it, order book for the first half could potentially be higher because the company managed to snag more contracts. It also announced a progressive dividend policy. Okay, so the company intends to pay 18 cents per share in annual dividend for this year, and that was 1 cent higher than last year's 17 cents. In addition, from 2026 onwards, it will pay an incremental dividend equivalent to 1/3 of the year-on-year increase in net profit. So this is what I call a bonus dividend. Should ST Engineering's profit increase in 2026 compared with 2025, 1/3 of this profit will be paid out as an additional dividend over and above the annual dividend that has been declared by the company. Not only that, but ST Engineering recently also announced Investor Day objectives, which is basically its 5-year targets for 2029. Okay, so the company aims to grow revenue at more than 2.5 times the rate of the global GDP growth rate to $17 billion. And the good news is that net profit, okay, will compound, meaning it will increase every year by up to 5 percentage points more than the percentage increase in revenue. So we call this operating leverage, where net profit actually grows faster than the growth in revenue. So what happened? STE's share price actually soared almost 87% year to date, okay, hitting close to an all-time high, okay, and you can see that because ST Engineering announced all these good news, that's the reason why its share price has done so well. So to conclude, the three banks have done the heavy lifting for the STI in previous years. Okay, that's already passed. So for this year itself, we can see a broad-based rally. It includes other components such as SGX, Keppel, and ST Engineering, which I've spoken about. The STI, of course, also includes resilient REITs such as CapitaLand Integrated Commercial Trust, and CapitaLand Ascendas REIT. And there are other components which I did not talk about, which also should contribute to its steady rise. Example, Singtel, which has been increasing its dividends and just recently, I think this morning, announced an increase in its underlying net profit for the first quarter of fiscal 26. And Sembcorp Industries also did well. It actually managed to increase its interim dividend from 6 cents to 9 cents. So as you can see, these companies are also doing well. So with better results, higher dividends, and promising plans for the future, okay, the conclusion is that STI can really increase one stock at a time. So as each stock releases their earnings, okay, then of course it will contribute to a little bit of the increase in STI. Together, they should be able to lift the STI to new records. Okay, thank you. And let's move on to Q&A now.
Thank you, Royston. So, okay, the Q&A, we've had so many questions come in. I was just trying to collate them while Royston was making his presentation. Now, by and large, I think the most questions come in asking, I'm going to direct them to Chin, on the MAS's $5 billion injection. First question, I'm going to read them all out at one shot, okay? And then
Sure.
if you forget them halfway, later on, Chin, when you're answering, just ask me again, because I'm looking at them right now. So, okay, will the $5 billion be invested in blue chips only? The answer is no, but I guess we can talk about it. Is the current level already fully priced with the money coming in? I guess the question is about whether or not the STI has already anticipated this injection. Jacqueline is asking regarding this revival, where can we get a glimpse of where the three fund managers are investing? Andrew is saying that $1.1 billion have already been allocated to three fund managers, and some small cap stocks have been very active and moving substantially. There is still another chunk of money to be released. Is there still room for these stocks to go higher? What kind of stocks should we be looking at? Okay, I think that is by and large those questions. I hope I didn't miss any MAS related questions out. Chin.
Okay, so many questions. So I think the first question Joanna has already answered on. It's not just going to be blue chips. I think part of the program is really to sort of spread. Is it too much to say spread the joy around? like not just on a few people who are receiving a lot of attention, but the goal actually is to actually shine a light on the mid caps and small caps and so on, right? So is the market pricing in this addition? I think from Royston's presentation, you can see it's very much broad-based. Certainly you can say that stocks are not as like cheap compared to say a year ago, right? So do you want to say that everything is being priced in? What I like to do is sort of change that question and sort of think about what you should have invested in before all this happened, right? And I will share with you one example on a stock we invested in since 2020, right? And that company is called SGX, right? And for a period of about 4 years, right, the stock actually went almost nowhere, right? It hovered around $9 to $10, right? And today it's, I think, closer to, should I say it's 15? Around about, Royston?
Around 16, yeah.
16, okay, even higher than what I thought. And the total returns, and don't forget the dividends, right? It's closer to like 80+% overall, right? And guess what? We have been investing in SGX, even though it has not been moving, and putting our money there. And my point here is that instead of trying to figure out how you're going to benefit from this injection of money, right? And try to pick and choose which company are going to benefit. Think about you don't want the companies to use Warren Buffett saying, rely on the kindness of the cash injection to actually gain, right? You want those companies to actually stand on their own feet and be able to deliver their dividends to you continuously. And that's really what we try to focus on. This injection of money, I get it. It's really exciting and it's boost share prices, right? And some of our smaller cap, I think one or two of them, Royston, you kind of look at the stock price movement and you kind of figure, they probably invested in these two companies, right? It's a bit hard to say that they did not, but that could be happening. But on the other hand, you don't want to be relying on the kindness of this fund to actually like boost the value of your shares, right? You want this shares value to shine through in the end, right? And more importantly, not forget that we are dividend investors, and therefore, what we really want is not just share price appreciation, which is nice, but also income appreciation, which is even better. So, for the last question as to where the money is actually going, unfortunately, I don't think any of the funds will tell you, and the reason is if they tell you, then everyone's going to buy those shares, right? And then the shares are going to become more expensive. So there's no way they're going to tell you which shares they actually invested. They don't want to pay higher prices.
Okay, thank you, Chin. All right, the next bunch of questions is actually based on because I shared some numbers about the portfolio earlier, right? So they'll have quite a few questions on that. So just Chin, I'm just going to keep you here so that you can answer these questions. But by the way, it's we usually run this webinar. It's in sort of celebration. We always run it around National Day. As this year is in celebration of SG 60, right? So it's the theme is always in line with our most popular service, the Smart Dividend Portfolio. It is a real money portfolio that we run in full view of our members. Real money means that we actually set aside a certain amount of cash for the year to invest in stocks. Then we show our members how to build a steady, growing, cash-generating portfolio made up of Singapore stocks. And we don't just show members what stock to buy. That's not enough. We show members how much of each stock to buy, and when it comes to that, when to even sell. So we are going to start running our sale from tomorrow onwards. If you're not a member already, it's a great time to join to get instant access to all the stocks, 26 of them within our portfolio. If you'd like to know more, keep a lookout for your invitation in your email inbox. The questions are, what is the CAGR, compounded annual growth rate, means the returns of the Smart Dividend Portfolio? What is the inception date of the dividend portfolio? We started in 2020. Next question is, how does the capital gain of 19.1% compare with the STI? I think, Chin, you can immediately answer the returns and then compare it to the STI. And then the last question is, based the dividends of, I mentioned it was, we have 15,600. How does it, is based on what amount? I think what might be more useful is if you can share, do you have the number handy, the dividend yield of our portfolio? So maybe Chin, maybe answer this. Okay, maybe, yeah.
Okay, quite a number of questions, right? So
it's actually just asking performance, so if you can talk about
yeah. So I think Joanna shared the figure just now of was it 30.8%, right? The gain of the portfolio, right?
Actually, right, I pulled out this number last week, I don't know whether I think it should be better to
let me have a quick check, right? I believe it's pretty close. I just updated it based on the stock market close yesterday.
30.3, I think. 30.3.
Yeah, so just a tiny bit less, okay? So here's the thing, right? This 30.3 or 30.8, as Joanna shared just now, is actually there's one factor which is dragging down these returns, and that's because when we started, it was only a $20,000 portfolio, right? And we have gradually added money. So if you think about it, if you have a number on top, and I'm doing a bit of maths, I'm very sorry. And you divide it by a larger and larger number because you're adding more and more money, right? The returns will actually drop, correct? So what I did was actually calculate the net asset value, right? Which is to say that I'm accounting for these changes. And if you go by net asset value, the change is actually, if you start from roughly about March 2020, or was it, February 2020 till today, the increase goes from 1 to 1.63, right? Which means that from a net asset value basis, the increase is actually 63%. Now, if you put it to CAGR, roughly about 5.42 years. I was doing calculation just now as Royston was talking. It's roughly about a 9.4% return per year, which I think is pretty darn good. And what
Okay, wait, maybe let me, sorry, I just need to interrupt
Yeah.
because I think that when you talk about net asset value and a lot of other things, and you talk about 1 going to 1.6, I think not, I think we have a lot of regular like lay people who might not understand what is NAV and
Okay,
all that
sure.
number. So wait, I think we can summarize it to say that the returns, if right, I'm just trying to summarize what you're saying, that
Yep.
it is the annualized return is 9.4% per year versus the Straits Times index of 5.6%. Right.
Correct.
Yes.
Right.
Okay.
So,
So that's
just-
the answer.
Correct.
That's the answer.
So
Okay, we're done.
maybe let me explain a bit clearer why I use net asset value, right? So for example, if you started with $10,000, right? And then the portfolio values goes up by 20%. So 12,000, right? 10,000 went to 12,000, right? And so your return will be 20%. 12,000 divided by 10,000, correct? But if you add 10,000, another $10,000, right? Suddenly the amount invested is 20,000.
Yeah.
And then the portfolio value goes to 22,000. Suddenly your returns drop to 10%, correct? Because it's 22 divided by 20, right? So that's what I mean by when you add more money below, which we have been doing every year, then the returns may drop. So to account for that, that's why we use net asset value. Okay.
Basically the number is when I talk about our returns, there's also a cash component, so it's not necessarily reflective. So the annual number that you gave, which is 9.6%, 9.4% versus STI's 5.6%. Okay, what about dividends then?
The 15,000, is it? What the yield is. So it's a bit hard to tell you like what the yield is based on, because that 15,000 is the accumulative dividends we have collected since the start.
Okay, for context, we invest every single month.
Yeah. So what I tried to do just now to answer your question was I looked at 2024's dividend payout, right? And I believe we got something like $4,600 in dividends, right? And then because we are adding money all throughout 2024, the average sort of like money injected thus far in 2024 was around 72,000, right? We started with 62,000, and by the end of the year, we had 82,000 of cash injected, okay? Cash injected, not the value of the portfolio. So if you take the average, it's 72,000, you divide it by 4.6, it's roughly more than 6%, right? So I think there are a few factors to consider here.
Yeah.
So for
I think
there's increase of dividends, and then there's also reinvestment. So whatever dividends we collected, we also reinvested, which really does help boost the amount of dividends we get over time, right?
The next bunch of questions I'm going to direct to Royston. Banks, everybody loves them. DBS is at
all-time high today.
If I'm not wrong, I didn't check.
Yeah, today is all-time high, 51.45 today.
Oh, 51, so nice. Okay, so anyway, the questions are should I buy bank stocks now? Is the anticipation of lower US federal interest rates make banks a good bet, even if the bank prices react to the lower interest rates affecting their net interest margins? So and then a very, very direct, DBS is $50. Can buy?
Okay. Actually, regarding the banks, if you look at their recent results, right, for DBS actually was the only bank among the three that still projects higher net interest income, despite the fact that they recognize that interest rates are going to fall, which will affect their net interest margin. So it's very interesting because DBS brought up two interesting points, which is we can grow our loans. Okay, so even if the interest rate drops, we can grow our loans to offset this effect of the interest rate dropping. And number two is fee income is also going to be strong. The reason is because DBS brings in a lot of wealth management fees. People spend on credit cards, they earn credit card fees, and that is something that's going to also offset some of the drop in net interest income for DBS. But of course, DBS is different from the other two. The other two banks, UOB and OCBC, actually project lower net interest income. Okay, so DBS is somewhat different. Maybe they are better able to buffer the drop in net interest margin compared to the other two banks. Okay, and as to whether $50 can buy, well, let's put it this way. If we look at the valuation of the banks, DBS right now is the most expensive. It's valued at around 2.1 times book value. Okay, if you look at the average for DBS over the last 10 years, it's been around 1.6 times. So just comparing these two numbers alone, okay, DBS shares do look very expensive. However, you can get around a 5% dividend yield if you buy DBS shares now. So I guess that is the mitigating factor. Even though shares may be expensive, but you at least can get a pretty decent dividend yield from DBS.
Thank you, Royston. All right, the next most popular, I mean, there are always these two hot topics, right? Banks, REITs, banks, REITs. The next one, I have to go to REITs. Okay, let me just pull out the questions. Interest rates are going down. So why aren't the Singapore REITs responding to a lower interest rate environment? Desmond is asking your top 3 recommended REITs, please. So Desmond, let me quickly answer for you. Please join our service, then you can find out all our top REITs and our top stocks as well. We have our top favorite stocks as well. The next question is, what about Mapletree group of REITs in comparison with CapitaLand group of REITs? Okay, maybe if I can ask both of you to maybe just talk about the interest rate environment, because I mean, Royston, you did present on it, and how the Singapore REITs stand, in this interest, and why are they not, why are they still priced this way? And what do you think of? Maybe just pick a few REITs to talk about.
Okay, I can actually start if you don't mind.
Yeah, please.
Yeah, man. So I think on the interest rates, right? What I see a lot of is the discussion of whether it's going down and when it's going to get cut and so on, right? And there's also the question is why aren't REITs going up in anticipation? I think for me it's not just about interest rates going down. Yeah. It's about how fast they go down and at what pace, right? Because if you remember back in 2021 when interest rates were soaring, right? It was sort of like the fastest in 40 years, right? It was an extreme sort of result, right? You went from 0 to like, I think 5% in roughly about a year plus, right? And this is a very extreme sort of increase now. And the thing about REITs is you didn't really see the impact on DPU until roughly about a year later, right? And I'm talking about the real impact, right? The unit price may have dropped, but then the real impact on where you actually get less income because they cut the DPU actually came in a year later. And that's because REITs have loans, right? And it's only when they refinance those loans, that's where you really feel the impact of higher interest rates. And if there's higher interest rates, there's less profits means less DPU for investors. So the same applies when interest rates start to go down. The impact may not be immediate, and some of the loans may still be at very, very low rates. So it really much depends on which REIT you're talking about, and that's what we actually are looking for. How that profile is spread out and how they would actually benefit. Could interest REIT prices go up in the interim? Yes, they could, but then this will be so-called not very much supported by fundamentals. We still need to look at how they actually impact the business before making a judgment there, right? Sorry, what other questions are there? Because
maybe I'd just like to add on to what Chin said.
Maybe Royston can.
The comment is that interest rates have been going down. I think what you are seeing is bank deposit rates have been going down. That's what the banks have been doing because they anticipate that interest rates will be cut. However, what we are seeing is the Federal Reserve has actually not gone on to cut rates yet. So
correct.
The problem is that REITs, until rates are actually cut by the Federal Reserve, will not get to roll over their loans at these lower rates. So when you see interest rates going down, that is only for your deposit rates. But the REITs themselves, they may still be borrowing at substantially higher rates than what you're getting on your deposits. So just wanted to add that point.
Yep. Is there any questions we missed?
Yeah.
No, the next question is is along the same lines. That's why I'm raising this now. With interest rates expecting to be trending down, what are the sectors that would benefit besides REITs? What do you think?
Okay, I can take this one. Well, I mean, it should be obvious that when interest rates go down, so any type of business which is heavily indebted that relies on heavy borrowings would benefit. Okay, and I guess right now what I can think of are telcos, because telcos generally borrow very heavily. Okay, so of course if they have to pay less interest expenses, telcos will benefit. And of course there are also companies like construction companies, for example. Construction companies also borrow heavily in order to finance their projects. And when interest rates go down, they will benefit because then they have to pay less interest costs. So these are just some examples of sectors. I mean, you can even look for any kind of company, maybe even oil and gas, which is heavily indebted. They will benefit when interest rates are cut. So just in a nutshell, any company with high level of borrowing, will benefit when interest rates are reduced.
But do you want them to have high borrowings?
Nope, that's another story.
When we look to invest, I think we can talk about this in the context of as we invest for our portfolio, right? Do we look for growth or value? What about dividends?
Right.
I think dividends are like the best thing about the Singapore stock market. Yeah, that's my quick answer. All right, let's go for Chin first.
You want to go first, Chin, or?
Yep,
Sorry,
Chin.
what? Oh, that was a question. I thought you
Yeah,
were
that was a question.
commenting.
That was a question. What do you look for to
I'm
invest, growth or
sorry.
value or
It
dividend?
sounded so the question sounded so intelligent. Oh, okay.
Talking about
What do you
dividends,
look for when growth, value, and dividends?
yes, when
Dividends
okay,
for sure. Yeah,
yes.
I mean this forum is about talking about investing in Singapore dividend stocks, right?
Yep.
So that's our focus. As to whether or not is there's growth or what was the other one? Value.
Value.
I think the way we look at it is sort of like three layers, right? And this comes from our other co-founder, David Kuo. So if you think of a pyramid, right? A pyramid shape. At the bottom, we want a very strong, stable layer of companies that can support dividends come rain or shine, right? And we like to invest in a whole bunch of them, keep ourselves diversified so that there's a very solid base where you can actually build a layer of growth on top, right? So at the bottom, you have what you call our income stocks. These are the workhorses of the portfolio. They do well in very different environments. And then on top, because you invest in sufficient amount of income stocks, say 60%, there's a layer of growth, which is something you can choose, 30%, 20%, up to you, where you can actually look for stocks which are growing dividends at a faster rate, right? And at the very top, right, you can reserve a very small part of it if you want, right? If you want, if you don't want, that's fine. Where we call it speculative, but it's not really like buying any company out there. It's really about a small little space for you to test new ideas. There might be new stocks or companies which have gone into trouble and you're curious about them. If you want to invest a little bit, the key idea here is to keep it really small and very focused. Don't go out that boundary. Leave that little space for you to test new ideas and so on. And if they do well, then maybe you can move it down to the growth layer or the income layer. But that's really how we look at the overall portfolio.
Okay, I'd just like to add, the focus, of course, of the smart dividend portfolio is on dividends. But what I've noticed, I mean, through all my years of investing, is that when the company actually raises its dividends, its share price also tends to go up. Okay, call it a bonus if you will, but ask yourself, how does a company pay higher dividends? That's because it's generating higher profits. That's the reason why it can pay higher dividends. So if the company generates higher profits, its share price will also increase. So you're actually getting the best of both worlds as an investor. You get your higher dividends, and the share price also increases because the company is producing more profits, more cash flow. So I would say that by focusing on dividends, you're actually also getting growth in the share price. So it's actually, yeah, you're getting the best of both worlds.
So I was trying to find the unmute button. Right. Okay. I just wanted to quickly answer a couple of questions. I think they're like on the same topic. It's a very quick one. Before I direct the rest of the questions to both Chin and Royston, is that the first question is, what's the difference between investing in the STI and Nikko AM ETF? I've been dollar cost averaging. Am I missing out if I don't invest in the STI? The next one is similar. Is it okay to just invest in the STI ETF? Am I missing out if I don't invest in the ETF? Okay, so the STI, basically the Straits Times Index, is made out of the top 30 companies in the blue chips, really. And so when we talk about the STI's performance, we always talk about as companies grow, some of them not doing so well, they might drop out. Some of them might join the STI. So basically, it's made out of the top 30 stocks, right? Now, there are ETFs or exchange traded funds that mimic these the top 30 stocks. So usually when we talk about the stock market's performance, we talk about the top 30 stocks performance, the STI's performance, right? And these ETFs, they will have the same proportion of you can actually see on the SGX website of the top 30 stocks. The three banks alone make up, like, I think, almost 50% of the STI already. Then you throw in the next two, and then it's like, I think, like 60 or 70%, something like that. So that is what the STI is. So if you're already invested in the Nikko, which I think is already, you're already investing in the index. So now when we talk about our portfolio, right, or we talk about anybody's portfolio, we always compare to the Straits Times Index, because you can always buy the Straits Times Index and get this return. So if I'm not wrong, the Straits Times Index today, right, the yield is about 4.55%. I don't remember, it's around 4-ish%. And so in our earlier question, we talked about the STI's returns in the last 5 years. Every single year, on average, in the last 5 years, it has returned about 5.6%. Right, versus our portfolio, which is not made out of the same number of stocks, we buy different stocks, has done about 9-point-something% per year. So just trying to give context to all the discussions that we've been having. All right. Okay, next set of questions is on when to sell. Should I take profit? Right, the market is doing well. Should I sell? Somebody saying that, my portfolio is up 27%. Should I take profit? From a portfolio's perspective, what are we doing at the Smart Dividend Portfolio? Royston, how would you assess which counters to sell and repurpose the funds versus companies that are expected to perform?
Okay, that's quite easy. Actually, what we do is we always focus on the business behind the stock. So what we do is we will analyze the business, including reviewing its latest earnings. We look at the prospects. We look at management's plans to grow, any long-term objectives set by management, like the CEO. And then after that, we decide, if this company still has potential for growth, then we'll continue to hold it, even if the share price may have gone up, I don't know, 50%, 80%, whatever, As long as we feel that the story remains good, then yes, it's something we will hold. And when will we sell? Okay, usually when companies get into trouble, and of course this happens from time to time, we will keep it we will keep it apart from the rest, meaning that we sort of put it like as part of a watch list where we look for further signs of trouble. Will these troubles persist, or will they be resolved? Okay, so of course, if the troubles persist for, let's say, 3 or 4 quarters, we may decide to sell and put the money elsewhere. So it's not just a 1 quarter thing where the company announces bad news and we decide, okay, no, we're going to sell. It has to be a persistent problem that the company cannot easily get over, and we decide to reallocate the money to a better position. So, I mean, that's generally how we look at it. We just focus on the business itself.
Can I add on?
Yeah, sure.
Yep.
Please go ahead.
Sure. So our co-founder, David, he wrote a book called How to Turn Your Child into a Millionaire. And he drew out a plan of how you could actually invest for a child and turn it to $1 million over 25 years. So one question is, what if instead of 25 years, say within 15 years, you actually got ahead of the plan, markets did well, and you reached that $1 million goal, right? should you sell? Is the question, right? Since you already meet the target, or should you keep on holding since there's another 10 years to go? And the answer is really, if that's your target, then you should sell, right? Because always remember that the stock market is a vehicle to get you to where you want to go, right? It can give you higher returns. In the case of our portfolios, about 9.4% per year, and which we're really proud of and happy about. And if that helps you get you to where you want to go, right? Then I think the best reason to sell is when you reach your own personal goals, right? If you sell because you're afraid that the market is gonna fall, then you're going to face another problem. You're just exchanging one problem for the other. Your worry about when the market's going to fall is going to turn to a worry about when should I get back in, right? And it's going to be really difficult because then you need to get two things right: when to sell and then when to buy again. So for us, we stay long-term focused. We're always looking at the dividends that are being paid, and if their dividends keep on going up on aggregate, then we're still happy.
The next question, we have quite a lot of questions on Sembcorp. Wait, let me pull them out. Here we go. Can Sembcorp increase its revenue this year? Why is Sembcorp share price dropping when it's paying higher dividends? Sembcorp has come down. Is it a buying opportunity? So maybe, Royston, if you can just comment a little bit about Sembcorp.
Yeah, the thing about Sembcorp, I guess I would just like to make a comment about the business itself. So Sembcorp, as you know, it actually has a portfolio of what you call electricity generating assets. So that could be like solar power stuff, it could be wind power. So the problem with this kind of business model is that Sembcorp is of course very sensitive to what you call electricity prices. Okay, so electricity prices are something that they cannot control. Okay, so the problem is when prices drop, they are price taker. They basically, even if they sell the same quantity of electricity, they're going to get less revenue, which is basically what we saw for the first half. The revenue did drop. I saw that, and the net profit stayed the same because they had good expense control. I mean, good for them. And I noticed that the CEO also paid a higher dividend, like I mentioned earlier. But of course, it's because he's confident that the future will be better. However, since they are a price taker, okay, they are also subject to the fluctuations in wholesale electricity price and all their power purchase agreements, okay, that they sign with, let's say, India or that, they do have a cap on the tariff rate that they can charge on the electricity that they sell. So that's also a problem because then you have to manage your costs. You cannot increase your revenue readily. Okay, so I guess that's the main issue with Sembcorp. And I guess for all those who are asking about Sembcorp, it's not as simple as it looks. Even though dividend is up, but the company may not have control over its pricing. So I would say that's a red flag.
Okay, thank you, Royston. Okay, now we don't have time for so many questions, but there's a very interesting question. If you only have $20,000 or $30,000 and want to place it in only 2 counters, which one would you recommend? Okay, before we're gonna talk about all that, I'm just gonna say we had so many questions this evening. Thank you so much for your wonderful participation. Right. Unfortunately, we can't get to all of them, but within the Smart Dividend portfolio, we also do run regular quarterly actually Q&A sessions where we answer questions relating to the stocks within the portfolio, and a lot of them are like, okay, this stock, how is it? Should I buy? Should I not? So just to let everyone know, we're doing our best to answer as many questions as we can this evening. So the thing is that I would say that we also every month release what we call the top favorite stock. So we not only release our top stock buy, but we also release a list of our top favorite stocks that you can look at beyond the stock buy of the month. So perhaps Melvin, if this answer is not enough for you, you're welcome to join us in the Smart Dividend portfolio. So it will be running on sale tomorrow onwards, so just look out for it in your email inbox. Okay, so the question is back again. If you have $20,000 or $30,000, your top stock, just give me a few names.
Wow. Few names.
Okay lah, no lah. Okay lah, it's okay for you. Just give me your top name, one name. I mean, okay, it doesn't have to be a super top stock, right?
Yeah.
As long as you think
So
it's good.
I think everyone will agree because I just have to like address because the question is asking like if you have 20 to 30,000 and you place it in I think 2 shares, right? That is not something I would do, right? So let's
yes.
put it out there first because I do believe that in fact when we started we started with 20,000 and we put it to work in roughly about 15 companies, right? And one of them was actually DBS, one of them were actually SGX. So I think that what money would I put it in right now depends on also what you need, right? I think the most important thing, it's not about what Chin wants to put in, but what you need for yourself. And I think that's a really important part because there are stocks which can pay you steady dividends. For example, Parkway Life REIT, right? Its dividend yield might not be really high right now, but in 2026, there will be the completion of all the upgrading they've done in their Singapore hospitals, and the revenue from those hospitals are expected to increase by quite a lot, right? And hopefully that also translates mostly into higher DPU as well. So that could be an option. But if you want higher dividend growth, then that may not always fulfill what you want, right? So I think really it's really about knowing what you want and then investing with that expectation. Otherwise, if you put in 20K and 30K or whatever amount you want to talk about into just 1 or 2 stocks, thinking that it's going to go up the next week, next month, or next year, then I think that's the wrong expectation. It's about really what you want, and from there you can figure out what you should invest in.
Royston.
Well, I guess for me, it's like some of the stocks that I will invest in, probably I would say are the REITs right now, because if you notice, the sector itself has not been doing well. And from what I've heard, a lot of people are really disappointed by REITs' performance. And the fact that other people are unhappy about REITs tells me that REITs should be very cheap now because they're unloved. So it's a bit of a contrarian view, but if you really put your money into very strong and well managed REITs, you do find over the long term. You want to know which REITs you can join our service? Yeah.
You're gonna buy some REITs soon, are you?
Yeah, probably, yes.
Okay.
Well, all right. Thank you so much, all of you, for joining us this evening. Before we wrap up, I want to leave you with this thought, right? You've seen how the STI is at its historic high. And how the right stocks can deliver both income and growth. And also, you've seen how our own real money portfolio has performed over 9% compounded annual growth rate. So everything we've shared tonight comes from the same process that our members follow us in our service every month. Clear plan, the right stocks, and discipline. So starting tomorrow morning, we'll be opening our National Day SG60 special. It's your chance to get full access to our flagship service, the Smart Dividend Portfolio. So you'll get to see all the stocks that we're buying, our monthly high conviction stocks, and our proprietary Smart Portfolio Builder framework. So I'll send you all the details by email tomorrow morning. So do keep an eye on your inbox. And we'll also be posting this webinar up on our site in the next couple of days. So keep a lookout for it. Have a good evening. Thank you, everyone.
Thanks, everyone.
Thanks.
Bye.